Welcome to our comprehensive guide on EPA Scope 1 and Scope 2 emissions reporting. In 2026, corporate sustainability has evolved from a voluntary branding exercise into a rigorous regulatory requirement. For major corporations, environmental, social, and governance compliance is now a mandatory part of financial and operational reporting. At the heart of this transition is the measurement and disclosure of greenhouse gas emissions. These emissions are categorized into three distinct scopes defined by the Greenhouse Gas Protocol. Today, we will focus specifically on Scope 1 and Scope 2 as these are the primary metrics required for compliance in the current regulatory cycle. Understanding these definitions and the data collection methods behind them is essential for any modern business leader or compliance officer. Let us begin with a clear definition of Scope 1 emissions. These are known as direct greenhouse gas emissions. They occur from sources that are controlled or owned by your organization. There are four main categories of Scope 1 emissions that a corporation must track. The first is stationary combustion. This includes every time your company burns fuel on site for things like heating boilers or running furnaces. The second category is mobile combustion. This accounts for the entire fleet of vehicles owned or leased by the company, such as cars, trucks, or even private aircraft. The third category involves fugitive emissions. These are unintentional releases of greenhouse gases, such as refrigerant leaks from air conditioning units or methane leaks from gas pipes. The final category is process emissions. These are direct results of industrial processes, such as the carbon dioxide released during the chemical reaction of cement manufacturing. Because these sources are physically located at your facilities or within your equipment, you have the most direct control over reducing them. Now let us move to Scope 2 emissions. These are classified as indirect greenhouse gas emissions. They are the result of the energy your organization purchases and consumes but does not produce itself. When you turn on the lights in an office or run a server room, you are using electricity generated by a utility provider. The emissions created at the power plant while generating that electricity are accounted for in your Scope 2 inventory. This category also includes purchased steam, heat, or cooling. Although the physical emissions occur at the utility plant, they are included in your footprint because they are a direct consequence of your energy demand. Measuring Scope 2 is critical because for many service-based companies, it represents the largest portion of their total carbon footprint. In 2026, the methodology for reporting Scope 2 has become more sophisticated. There are now two distinct ways to calculate these emissions. The first is the location-based method. This reflects the average emissions intensity of the local power grid where the energy is consumed. It gives a realistic picture of the physical carbon footprint of the electricity flowing into your building. The second is the market-based method. This allows companies to account for their specific choices in energy procurement. If your corporation buys renewable energy certificates or signs a power purchase agreement for wind energy, the market-based method reflects those lower carbon choices. Most regulatory frameworks now require companies to report using both methods. This dual reporting provides transparency to investors about both your physical impact and your strategic efforts to purchase clean energy. The legal landscape for emissions reporting has changed dramatically in 2026. For many years, the EPA Greenhouse Gas Reporting Program was the main focus. This program required high-emitting facilities like power plants and refineries to report their data annually. However, we have now entered the era of universal corporate disclosure. In the United States, the California Climate Corporate Data Accountability Act, also known as 253, is a major driver of change. Starting this year, large companies doing business in California are required to publicly disclose their Scope 1 and Scope 2 emissions. This law applies to both public and private entities with annual revenues exceeding $1 billion. It has effectively set a national standard for reporting in the United States because almost every major corporation has a business presence in California. At the federal level, the SEC climate disclosure rules have introduced a new level of financial accountability. Publicly traded companies are now integrating their emissions data directly into their annual reports. This shift means that carbon data is now treated with the same level of scrutiny as financial data. In 2026, we are seeing the first full implementation of these rules for large accelerated filers. The goal is to provide investors with consistent and comparable information about how climate change and carbon regulations might affect a company's financial performance. This regulatory pressure is also being felt globally through the European Union's Corporate Sustainability Reporting Directive, which affects many American companies with significant European operations. The process of gathering this data requires a coordinated effort across the entire enterprise. It starts with establishing organizational boundaries. You must decide whether to use an equity share approach or a control approach. The equity share approach means you report emissions based on your percentage of ownership in various business ventures. The control approach means you report 100% of the emissions from any facility where you have the authority to implement operating policies. Once the boundaries are set, the data collection phase begins. For Scope 1, this involves gathering utility bills for natural gas and fuel logs for company vehicles. For Scope 2, it requires collecting every electricity bill from every office, warehouse, and retail location in your global portfolio. After the raw data is collected, it must be converted into carbon dioxide equivalents. This is done using emission factors. An emission factor is a specific value that converts an amount of fuel or electricity into an equivalent mass of greenhouse gases. These factors are updated annually by the EPA and other international bodies. In 2026, companies are increasingly moving away from manual spreadsheets and using automated reporting software. These digital platforms can integrate directly with utility providers to pull data automatically and apply the correct emission factors in real time. This reduces the risk of human error and ensures that the final report is accurate and auditable. One of the most significant changes in 2026 is the requirement for third-party assurance.